We are really tightening up for 2 weeks now with small ranges after a decent move. Where are we going to break out of this consolidation? Are we going to go up? Are we going to go down? In tonight's video, I'm going to tell you what I think we're going to do and why, and I'm going to tell you how we can take advantage of one sector and a stock within that sector that's really been outperforming the broad market and how we can take advantage of that. So let's go ahead and get started. Today is Friday, May the 25th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. There's a lot of people who watch this, just like you, so we'd love to have you. Subscribe to our YouTube channel by mousing over the logo in the bottom right corner of the video and then click that red subscribe button. Click the thumbs up icon right below the video. That tells me two things in one click. It tells me, number one, that you got something out of the video, that you liked it. Also tells me, number two, you want us to keep doing the video day after day. It's a one-click way to give us feedback there. Comment on anything that stood out to you from tonight's video. Scroll down to the bottom of the page to do that. Join our Market Outlook daily email list. There's a link in the video description to do that. Follow me on Twitter for more content like this throughout the day, throughout the week. You'll see my handle up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet. And then finally, join our Market Outlook community. Really going strong, 1,000 plus strong on Facebook. There's the address at the top left corner of your screen. There's also a link in the video description that will take you there. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You see we maintain a strong bullish posture, as sideways as we've been the last 2 weeks. We maintain the strong bullish posture here, even if the near-term, short-term sentiment really hasn't done much of anything. I mean, dropping a little bit below 40 on the low end, getting up a little bit above 60 on the upper end. Still up above 50 at least, so even though it hasn't quite gotten up above 80, which is what we want it to do, you know, it's got, what, 1, 2, 3, 4 days now up above 50. 7 to 12 is the number we look for, and that's, you know, we were close in that area there and haven't really got a good established bullish high point because we haven't broke out yet to the upside. Momentum line fell, did not fall to a low point below 20. You can see both times that it has, we've bounced right off of that. So we're not getting a bullish intermediate confirmation signal, but you know, like I said, the posture is strongly bullish. When that market sentiment line gets above 50, rises and gets above 50, then we know things are gonna, you know, really be where we'll get a good long extended intermediate market sentiment run. And I brought this up in my class yesterday, my portfolio management class. When you take a look at the last market sentiment run, so the last time market sentiment here in orange got below 50 and then went all the way till it dropped below 50 again. So we had this run here. You can see the intermediate runs here visually with the green. I mean, temporary shades of light pink, which means you have a weak bearish posture. It's the dark pink where you get the change, right? That's when the intermediate line falls below 50. So that's when you get the new intermediate low points. So from a visual standpoint, you can see during this market sentiment run, we had 1, 2, 3, 4 intermediate rallies. So 1 market sentiment run, 4 intermediate rallies during that run. And the first one and the last one were just abnormally long. This one was 4+ months. This one was 5+ months. They all had clusters. This one had multiple clusters towards the end. This one had clusters towards the beginning. And then this one had 1 cluster at the beginning. This one had 1 at the beginning and towards the end. So all clusters here during this market. And then, of course, now we've got the market sentiment pullback. And again, we haven't had one since this area here when we had the market sentiment line pullback. So you can kind of see what the market sentiment pullbacks look like. And you know, we got extended periods of dark pink. Not that they're long like the dark green, but there's a lot of it relative to when we're bullish, right? When there's hardly any pink, dark pink. So, I mean, we're on intermediate run number 1 right now. Whatever shape that formed, I don't think it will be 4 months like this one, or definitely don't think it'll be 5+ months. The typical range is 1 to 3 months, like these two here. I mean, these are typical intermediate runs. This one, because market sentiment was already so high, it didn't last very long. This one too, market sentiment is already relatively high, and it got, over 2 months. We were coming off a low point around the 60s. A little bit lower than this one. So we had a little bit longer of a run. This one, again, like I said, abnormal. We probably should have ended it right here, but tax reform pushed us up on this last leg. Same thing over here. You had this nice run that probably should have ended right here because we were coming up off a market sentiment low point pretty deep. You had a multi-month run. Probably should have ended right here, but it kept going. One last push into February, past February expiration, and so we had an extended intermediate pullback because of that. See how these intermediate pullbacks were not very extended because we didn't have an abnormal run that preceded that. So, we are in that run right now. Markets were above a upward trending moving average. That's also a hallmark of an intermediate run. You can see you don't get very much yellow here or red. You get a lot of green, a lot of green, a lot of green, and a lot of green. Temporary yellows. Temporary yellows here during the brief weak intermediate rallies, but during the intermediate pullbacks, the weak bearish postures we have, you might get a temporary yellow or red. But for the most part, you're above an upward trending moving average, and that's what we are right now. Above an upward trending moving average. Market sentiment hasn't crossed above 50 yet, so that's why we're really not taking off. That's we will, and once we get above 50, we will take off. In what form? Most likely not like this, like we've seen before. But there will be a move similar to this or this one, probably more similar to this one here, where we'll have a pretty decent rally forming. Market sentiment is rising, so that's a positive sign, and you can see the intermediate posture is also strong. It's up there above 90 for the S&P 500. For the Dow Jones, at least you're above 85. We get a little bit more of a pullback, but you have a rising market sentiment line there too, and also it's lower. So again, it's not going to this isn't going to take off overnight. And again, for perspective's sake, on that last market sentiment rally, that's what it started back here, right? And there's one, there's two, kind of a big second one after that deep pullback. Big second one. Then we had this pullback on the intermediate basis, and then there's 3. So whereas the S&P kind of broke that up, the Dow Jones only had 3 intermediate rallies during that market sentiment run. The NASDAQ, you can see after getting a cluster yesterday that Brandon highlighted in the market outlook video last night, its market sentiment's also rising closer to 50 than the Dow and the S&P 500, above a rising moving average. So we're on intermediate run number 1, and then finally the Russell 2000, which is the strongest. Its market sentiment is above 50, and that's why I think there's a good chance the others will also climb above 52. We are above 60 and rising on market sentiment, and that's why, again, it's more bullish because market sentiment's higher. It doesn't have, its path of least resistance is to the upside, and because of that, whereas the path of least resistance for the others, where market sentiment is still below 50, it's still down to sideways until we can get up and going here. And you can see that the Russell 2000 breaking through that high, a little bit of a pullback, but opportunity now for a short term. After this short term bounce, a higher near term low point forming. Now we're back up above 50, and we'll see if that near term line makes its way back into the upper reversal zone, which is what you would want to do to confirm the existing strong bullish posture that we have. All right, before we look at additional charts, just want to take a quick minute to plug the like buttons that are on the Market Scholars blog here, all in one spot for you. Again, 3 clicks tells me that you want us to keep doing these videos day after day, and you can do it right now while you're watching. One is the like button here on Twitter on tonight's Market Outlook tweet. I've embedded right below the video, so you can see it right now while you're watching. You don't even have to go to Twitter. Same thing with Facebook. Click the thumbs up there, and then the third one would be this like button here on the blog. Those 3 clicks, which you can, like I said, you can do right now, go a long way to telling us that you appreciate these, that you're getting something out of these videos, and you want us to keep doing that. Remember too, if you have not joined our daily market outlook email list, you can do it right now too while you're watching with this form at the bottom of today's blog post. And also there's a link up here to discuss tonight's video or any other video or any questions you have in the Market Outlook forum here on marketscholars.com. To participate in that forum, you have to come up to the top right and click on that subscribe button and subscribe to the site. Then you can be able to participate in that forum there. All right, back to the charts, and you can see on the long-term charts, we're still above that rising 50-day moving average. The 50-day moving average still pulling away from the 200-day moving average, which is reflected with this rising MACD down at the bottom. So still strong bullish momentum on a long-term basis. We're not really pulling away from the 50 until we break out of this 2-week range. Look at how small the ranges are these 2 weeks compared to the prior 2 weeks. So very small ranges, and you know, considering the trend, we would expect the breakout of this 2-week range to the upside. If we take a look at the 3 green arrow chart for the S&P 500, of course, we now do not have 3 green arrows, so we're going to be not shaded green here. Does not mean that we're bearish. You can see again, there's your, you know, on this perspective, if you want to see what that those 4 intermediate runs look like, you can see there's the first one, right? All green with some non-shaded areas, and then once you get the pink, which means we're below, or we got 3 red arrows on these charts, then that's when the intermediate run stopped. There's that second intermediate run. There's the third one, and then of course this is the big 4th one here, where we briefly had, you know, a set of 3 green arrow, 3 red arrows. So that big, this is the big last one. This is the big first one. Then we had this, you know, that two-month run there, and the 1-month run after that there. So you can kind of see when you put those 2 things together, green shading on this chart, on the 3 green arrow chart, and you know, green shading on the market forecast chart, then we're on a bullish trend. That's pretty good. That's what we like to see. But like I said, we got 1 red arrow today, so the MACD is below its moving average. You can see that on this chart. The MACD just a smidgen below its moving average. The stochastics is trading right around its moving average. I mentioned to you before, we're trading around that 8-day moving average. We're testing the 17-day. It's okay to do that. If you break below the 17-day and close towards the 30, then we're starting to, you know, then we can expect, you know, a convergence down towards 0 on the MACD, that we're kind of heading down that direction. We're not there yet. We're still testing the 17-day. So when you test the 17-day, like you over here in September, you can expect it to bounce, and especially when you're just barely starting an intermediate run, expect it to bounce off the 17 and make a new run above the 8. So that's kind of the move here I'm expecting. I'm not expecting, you know, the cross. So see here, like I said before, this is where, you know, we had the tax reform bill that created that fluff that was corrected here. That's probably where we should have pulled back once we tested the 17, broke it, and started testing the 30. That's when the convergence should have made its way to 0 and then diverged to the downside. Healthy pullback and then a bounce. Then we'd have felt much better about things. We never got that. We never got the exhale. We started the exhale, and then we took another big deep breath. Big deep breath in, you know, inhale, started the exhale, and then whoa, big inhale again, and that's when you just ran out of gas, right? You ran out of breath, and you had to take a big deep exhale to get to normalize the breathing pattern. Stocks are the same way. Stocks look very similar in that regard. So right now we're getting you know, a little bit of a test of the 17-day. Like I said, expecting to bounce off of that. Doesn't mean it will, right? We could definitely break to the downside, because anything can happen. But according to the trend and everything we've been talking about, you know, I would expect that we'll break out and get back above the 8-day and get that thing going again, and get the MACD to rise again too. Eventually making its way to the downside. You see here, eventually it'll grind its way to 0, but I don't think on this one yet. I think we're still too early in this current intermediate run. Could we have a more neutral intraday chart than we see right here? I mean, look at today's range, as small as it was. I mean, hardly anything. What was today's range? Well, we'll take a look at the daily chart. Well, we'll take a look at the daily chart in a minute, but you can just see visually, very, very small range. Completely inside of yesterday's range, which is completely inside of last week's range and this week's range, which barely nudged. This week's range is pretty much, in fact, it's a little, the high went a little bit higher and the lows also went higher. So we actually have a tighter range this week than we had last week. And last week's was pretty tight relative to the 4-week range. So, we're really tightening up here. If we don't break out to the upside and we instead break out to the downside, eventually this is going to start moving up and the 4-week range is going to tighten up. If we don't start breaking out to the upside and this thing tightens up, then that's a concern from an intermediate perspective in terms of how bullish we are. But again, like I said, because of all these factors we've been talking about, we'll keep an eye on this 274.25 level and look for a breakout here to the upside, especially 2 weeks in a row like this. Granted, we had a nice good move to get to this point off of that low point, 259, getting to 274. That's a $15 move. It's a pretty decent move in about a week plus to get to this point. But now we've consolidated and we're really, really tightening up. Expect a breakout outside of this consolidation in the same direction that you had coming into the consolidation. That's typically how continuation patterns work. Long consolidations like this aren't typically reversal patterns. Doesn't mean they can't be, but not typically. So we would expect they're more typically continuation, which means you expect a move out of it that you had, similar move out of it that you had coming into it. All right. So now we can look at the range and you can see they are up to 1 point, just over a point. You can see the volume below average, and that average volume continues to trend lower here, coming down, down, down. When you look at the ATR here, let's see here. You can see, I mean, the ATR is now below 1%. It's 1% a pretty decent limit in the past. I've mentioned that before too. 1% on the ATR. Well, here, let me, I'll draw that horizontal line. We'll just kind of leave it on there and establish. We'll edit that property and we'll send that off to the left and we'll just leave it at 1. So 1% is typically a pretty good peak in the past for the ATR relative to the current price. And we've obviously been above that this whole time, and now we're starting to make our way down back below that. And you can see when you do get below that, we can stay below that and grind our way higher for quite a while. So positive sign there. Volume continues to move down too. Stocks grind to the upside with low volume. That's kind of how things work. Now you need big volume, bigger than average, probably about 100 million. Once we start breaking through some of these highs, to kind of solidify those breakouts. But as we head into it, you're probably going to continue to see lower volume, especially the average, continue to come down towards the lower end of this 52-week range. Volatility can't get below 12.5. It's having a hard time getting below 12.5. It's kind of staying in this 12.5 range, which was the high end of volatility all throughout most of 2017, briefly getting up to 15 a few times. Now it's the low end, right? Low end of the new range. And 20 is the higher end. So it's kind of stuck in this area here. That's why I say it's not, until we get that market sentiment above 50, we're going to have some, it's going to be volatile. Not this volatile, but more volatile than what we saw in 2017. You can see too, the other thing, to stay bullish, we need this to stay below 90%, which it is doing so far. So that's strong. That's good, but it needs to get down and closer to 85. That's the sweet spot, above and below 85, for us to get on and maintain a nice, good bullish trend for volatility. It's staying in the higher end, which means there's still a little anxiety about whether or not we can stay bullish. Once it starts to drop down, then we'll feel better about it. All right, to summarize things, the market posture remains bullish. We are in this first intermediate rally of what could be a new market sentiment run, long-term run, but it's very nascent. We're just starting. Market sentiment's not above 50 yet for most of these indexes, like it is at least for the Russell, which is the strongest looking chart out of all the major indexes. So, there's the likelihood that we'll get there on all these others, just not quite yet. And that's why things really aren't looking so good. But we've had 2 weeks of really sideways action, consolidation. We had a decent move coming into those 2 weeks. Most likely going to get a move coming out of that to the upside. And of course, anything can happen. But those are the expectations that we look for. And so tell me what you think. Is the poll that's popping out to the top right corner there, do you agree, disagree with that market posture? If you do disagree, comment down below. Love to hear your thoughts on what you're seeing, what you're not seeing. And share your thoughts there. If you remember, when you click on this eye, you can see over here, I'm clicking on the site here. If you click on the eye in the YouTube, top right corner of your YouTube video, you can see that poll anytime. We got 68 responses out of 1,000 plus views on the video a couple nights ago. So let's see what you think. I'd love to hear more, see more responses. Also remember too, you can see a few links. Here's the link to the subscribe to marketscholars.com. That will take you straight to our subscribe page. That link will take you to our blog if you want to see all these links that I've shown you before. And of course down here, this link will take you to the Market Outlook forum. Remember, to participate in our forum, our community here, Market Scholars community, you have to subscribe first. All right, now let's talk about what's driving the price action. And just taking a look at the charts here over the last couple of weeks, you can see the dollar has been really, really strong. It's had a good 2-week run. So as during this sideways action that we've had in the S&P 500, has not been as sideways in the Russell. The Russell's been up 1%. So it's been, there has been some buying of equities. You can see the dollar has been very strong during this past couple of weeks. So it's had a decent run. Of course, that's put pressure on things like gold and emerging markets, international stocks as a whole, but emerging markets, gold, foreign bonds. Crude oil was able to maintain its relative strength, but look at the big decline it had today. So we had a few days of declines here earlier this week, and then whammo, today's really closing in. And just for some perspective on this, let's go back out, a couple more weeks. To see, you can see that crude oil had been a big performer, a big gainer. There's small cap stocks too. So small cap stocks maintaining that relative strength, but crude oil really dropping off because it had been so strong. I mean, it was up 7% in a matter of 4 weeks. If I were to zoom out a little bit longer on this, go out 3 months, it was up 13% over a 3-month period. Even with a strong dollar. So I mentioned at some point in time, one of those things had to give, and I was actually expecting the dollar to give way, and so far that's been the crude oil that's given way, and the dollar to maintain its strength. Considering, again, this idea that we're in the late stages of a long-term bullish cycle, I still think commodity prices as a whole will maintain strength. I think this will be a pullback, and it's as deep as it is because of how strong crude oil has been. I mean, look, over 6 months. I mean, the longer I go, the bigger the move gets. So, I mean, again, you get big moves, you're going to get bigger pullbacks. That's just the nature of how things work, right? So if I were to draw off that low point up to this high point, I mean, there's a 50% retracement of this rally that we had on crude oil over that since the beginning of April. So this is how it works, and we can come down to 62% and still hit those old highs over here for USO. So, that's, and if I were to even zoom this out a little bit further, I'm going to activate that and then move this out here to this low point for crude oil, the orange line. Then again, you can see we're heading down towards 38% Fibonacci retracement, which is, again, lines up with that low point. So big moves lead to bigger pullbacks. That's not, and on a relative basis, it's not that big. On an absolute basis, it looks really big. On a relative basis, according to the Fibonacci lines, not that big, and that's why it's pulling back as much as it is. If you take a look at some things that's been driving the price action today, we had a couple things on the calendar. Durable goods orders You always like to look at the yearly numbers pulling back a little bit. In fact, all economic indicators have been pulling back, especially on a global basis, right? It's a very, very negative number, but not nearly as positive in the U.S. as we've been. We had durable goods. We also had consumer sentiment out. This is the final revision to the University of Michigan Consumer Sentiment Survey. So a little bit of a pullback, but still relatively high. So again, that's why we're still positive, but not as positive as we've been. Now we're not, blowing away these estimates anymore because we've been pretty strong for so long. The GDP estimates came out today with those durable goods orders and are, a little bit of a pullback, but still 4% for the second quarter. So, again, we're a long ways away from this being released, but still maintaining strong positive economic growth expectations. We already know earnings growth has been strong too. But with prices pulling back and these economic indicators starting to not really outpace those estimates anymore, you can see the odds of a rate hike. This is December. This is the odds for a December rate hike. They're pulling back too. Look, from a week ago over here, we had over a 50% chance of getting a rate hike every quarter this year. March, June, September, December. And now we have barely more than a 30% chance that we'll get that fourth rate hike for the year, for the calendar year, in December. So, things are moderating a little bit in terms of, this inflation and things like that. And that's actually the market might pull back a little bit on that, but that's usually been seen as a positive when the Fed's not as aggressive, because the Fed can raise rates and the market can keep going up as long as that yield curve, as long as the Fed doesn't raise rates too quickly, which is what that yield curve, whether, if it inverts, then the Fed raised rates too quickly for what economic expectations are. Economic expectations are still doing pretty good, and things are moderating a little bit, which allows the Fed to slow down a little bit and not worry too much about an overheating inflation rate or economy. All right, when we take a look at what's going on from a sector rotation standpoint, the two sectors that have been really outperforming everybody both got bearish clusters yesterday, the technology and discretionary, overbought clusters in this technology and discretionary area. There, you can see the weakness there in energy with intermediate line now falling below 80, so a bearish posture on energy. In fact, it's the only one that's got a bearish posture. The only other lines that have falling intermediate lines, financials, materials, and healthcare, all still are above 80. So it's the only bearish posture we have right now, albeit a very, very weak bearish posture. Again, a reflection of how bullish markets are right now. Again, you can see what has been bullish: financials, materials, industrials is getting above 50, and it's still rising. Staples has been weak, and utilities have been weak, and you can see they're starting to get some relative strength, and real estate as well, and telecom, some interest rate sensitive areas. They've been very, very weak on the intermediate basis, especially staples, basing and starting to make its way. Still not above a rising moving average, so we're not green like we are in some of these others, right? That's the key, and you're not getting 3 green arrows in some of these either, as we've been pulling back towards the moving average. But on some of these others, we have some pretty decent relative strength, especially here in the industrials area, as we are rising up above 80. We're above 80. We're above a rising moving average. We're not pulling back to it like financials, like materials, and especially like energy, these other really strong areas. And of course, technology and discretionary showing their clusters. We're not getting a cluster or a pullback. So industrial is kind of giving us some, a pretty decent week here on a relative basis compared to its other sectors, its counterparts. And that leads us to our trade idea of the day, and that's the I want to take a look at a stock in that industrial area, and that's UNP. UNP is not a small cap stock, yet its chart looks like the IWM, right? We have broken through that January high that was so bullish in the markets, and then we pulled back, and then we pulled back again in this March-April area, but we didn't pull back as much in UNP, and we're already through, whereas the SPX is not through its highs. right? This low in early April was equal, and we're not even above those highs in March, much less the January highs. UNP, we are, right? We are above those March highs. The April low was not as low. We are above that March high, and we are above the January high where we got those clusters over there. So pretty decent relative strength in the sector. It gives us an opportunity for bullish trade. Again, we're not that bullish with market sentiment as low as it is. We've got that bias, but we're not really kind of gung-ho, and that again tells us to look and keep an eye on less aggressive bullish trades like these short put vertical spreads, which give us a less return potential, but a higher probability of success. And if we look at that 141 strike, we'll go out to the 45-day window, look at that 141 strike, protect that short put with a long put, right? So short put means all I need to make that $249 per contract, all I need is for UNP to stay above 141. If I buy a put, I want the stock to go down. If I sell a put, I don't want it to go down. So if I sell the 141, I don't want it to go down below it. So as long as it stays above, we're already above it, 145. As long as we stay above it, great, right? So, but to protect against a big move to the downside, just in case, then we'll buy that 139. So I'll give up 200 out of the 249 to try to get out, something. In this case, about the goal is try to get at least $47. That's a 30% return on risk. That's a good balance between risk and reward and probabilities of success. Is that 30% return on risk, and so we're getting if we can get above $47, it's a wider range. You're gonna have to fiddle around with this to get filled in at a decent price, but anything above 47 works. And then you can see if I analyze this trade, I've already got a few here, so let's get rid of these other two, and then set my slice to break even at on 7/7. It's going to be the week of July the 4th. And then we'll set that slice to the chart. That's where that blue line comes in. So there's some old highs as well as that near-term low point here, a couple near-term lows that can act as a support level if we are to have a little bit of weakness here. Again, I don't care if we're weak as long as we stay above here. If we get below it and we start to cross below 140 and we cross that threshold here, then you notice I'm going to lose about $40. See in the bottom left corner, I'll lose about 40 some odd dollars. And at that particular case, I will take that loss. I will just get out of the trade. I'm not going to wait and let the probabilities work out, because what I don't want is a $147 loss, which is the maximum if we were to keep going down and break through and whatever. So I don't even want really a $100 loss, because that will take two max gains to overcome that. So if I just get out with a $50 loss, which is about what I'm trying to make, great. Then I can live to trade another day and get out, and move on to something else that's got a relatively decent probability of success. So tell me what you think about today's trade idea. Tell me what you think about today's market posture. Do you have any questions? Do you have any comments? There's a link that just popped out in the top right corner of your screen that will take you to our Market Outlook forum on marketscholars.com. Love to hear your thoughts. See your thoughts there. There's a lot of you that watch these videos, so there's a lot of different things that we can be thinking. So we'd love to see what your thoughts are on those main topics of tonight's Market Outlook. As always, thank you very much for watching. I appreciate your time. Have a great Memorial Day weekend, everyone. Remember, we're not teaching classes on Monday because of the holiday. We'll be back Tuesday, so check the calendar for our classes there. Remember to subscribe to our YouTube channel, like today's video, comment on anything that stands out, follow on Twitter for more content, and join our Market Outlook community on Facebook or on marketscholars.com. Have a great evening, everybody. We'll see you all next time.